Well, hi everybody. Good to see everyone again. Thanks for joining. Really excited looking at that calendar for February that you've got that Matt in America on there every Tuesday for the month of February. So far, hope everyone's found a lot of value in the different topics that we've had. Today is going to be a great one. We have our business partner, Brian Urie, who's with our wealth management team that's going to share a lot of really good information for you. Just as a reminder, we are still offering that complimentary one-on-one financial coaching for anyone out there. We've had some great appointments. You are all very financially savvy, so continue scheduling those appointments with us. And I'm going to turn the time over to Brian. And Brian, if you just want to tell us a little bit about yourself, we'll get started. So thank you for having us, everyone. Well, you're muted, Brian.
Everybody loves talking about themselves, right? I've got to take myself off mute first, though. My name is Brian Urie. I am the retirement plan advisor at Mountain America Investment Services. I've been doing this for almost 25 years. It'll be 25 years this August. And that means over 1,000, well over 1,000 families that I've met with about their retirement planning. And I hope to share with you some of the lessons I've learned over that period of time, and certainly believing in continuing improvement, continuing education, so I can share with you also what the industry thinks about retirement planning. So I guess I should say, while I am an employee of the credit union, I am a licensed uh, wealth advisor through LPL Financial, which is a broker dealer as well as an investment advisor. So that's the company through whom we offer investment services, investment products, and investment advice to our members and to the employees of our great select employer group partners like the state of Utah. So let me share my screen. I'm sharing the wrong screen. Hold on one sec. Oh, there we go. So let's start out by hitting straight on, why is it so hard to take care of our future selves? As you think about that, I should say compared to the needs of our current self, that's the struggle that's always going on, right? Should I take care of future Brian or should I take care of current Brian? And as you think about that, if you'd like to scan this QR code, you should be able to send a text. I better pull that up so I can monitor it during the presentation, and I'd be happy to answer those as they come in. But I'm just going to monitor it on my phone. Why is it so hard to take care?
We can also throw the questions in the chat too, and I can read them off to you in case you miss them.
Cool. Thank you very much. Professors or researchers at UCLA have done quite a bit of work on this subject of taking care of current self, future self. One of the studies focused on fMRI scans that they would be viewing while interviewing subjects in their study. And so while monitoring brain activity, they would ask the subjects, what are you doing right now? And they looked for what part of the brain had an increased level of activity. The next question they asked, what is Brad Pitt doing right now, or some other stranger? And they looked for what brain activity was going on and what areas of the brain lit up. Then they asked, what are you doing in 5 years from now? And the thing that surprised the researchers was that the increased activity in the areas of the brain that experienced increased activity were the same when they asked, what are you doing in 5 years from now? And what is a stranger like Brad Pitt doing right now? What it suggested to the researchers is that our brains tend to think of our future selves as a stranger. No wonder it's so hard to save for the future, right? Or to diet, or to exercise, or do anything in terms of healthy living, because our brains are wired to naturally feel more compassion towards the needs of our current self rather than our future self. So to further test this hypothesis, they took pictures of the people in the study, and then they applied age progression through software to those pictures to suggest to the individuals what they might look like in the future. And as they introduced their future selves to them, that group experienced an increase in average savings for the future. So what they concluded was that it's okay that our brains think of our future selves as a stranger, as long as we can take steps to develop compassion towards that stranger. We feel compassion towards strangers all the time, don't we? So here's what I did. I took a picture of myself and other people that I've been accused of looking like the guy from Pawn Stars, Dwight Schrute, the drummer from Metallica, and Brian Urie. Now, I was looking at this yesterday. If you look close enough, the noses, and it's only the noses, look fairly similar. But Brian Urie, by the way, frontman Panic at the Disco, I don't know him, but our grandfathers were brothers. And so I thought I would use the FaceApp app to age progress these pictures and see who holds their age the best. Should we see? So when I look at that picture of future Brian and I look at the lines in the forehead, the lines in the cheeks and the eyes, more so than I already have right now, and I can't help but feel compassion towards that guy. And I know that nobody's going to take care of him if I don't. So already I'm feeling some compassion. Let's see how the other ones did. Not bad. Really weathered. Not bad either. And then, of course, Brendan, he's still handsome at age 70 or whatever he's pictured in that picture. But I invite you to do the same, by the way. FaceApp is one of the apps. Aging Booth is another app on your phone. Get introduced to your future self. I bet you'll feel some more compassion towards him or her. Let's address 4 questions that I get asked most often about retirement planning. First one is, why save for retirement? The second one is, how much should I save? The third, how do I tell if I'm on track? And fourth, which of all the investment options I have to choose from should I be using? And should it be different at different times of my career? Well, starting with why save for retirement, it's no surprise that everybody is living longer. When I think of retirement, I think of my grandfather, Robert Bauer, who for most of his career herded sheep in the mountains above Cedar City. And he worked until he was 70, retired at 70, and then lived until age 82. So he lived for 12 years. He and his wife, my grandmother, lived for 12 years on the savings that they had saved over a career of 50 years. The math isn't so difficult there. But when you fast forward to our generation, with us living longer, our generation could be retired for as many years as we were working, saving for retirement. That is challenging for savers, investors. That's challenging for financial planners to figure out how to make that work, with so many more years that we need to live off of what we've saved. Social Security benefits haven't shrunk, at least in a gross amount, but years ago, Social Security began to be counted as taxable income. In fact, if your household income in retirement today, if you were retired today with more than 45,000, 48,000, it adjusts every year, 48,000 a year of retirement income, 85% of your Social Security benefit would be taxable. So while Social Security gross benefits have not gone down, with them now being taxable at lower levels, the net take home from Social Security. I think that's what they're referring to when they say shrinking Social Security benefits. Healthcare costs is a tough one for us to estimate because it has its adjustments from year to year are really tough to project and keep up with. Fidelity, thankfully, does a projection every year, estimating how much a couple age 65 needs to have earmarked to cover their out-of-pocket healthcare costs throughout retirement. And the latest number I saw was something like, I think it was 295, something like that. 295,000 is what needed to be set earmarked to just cover out-of-pocket healthcare costs. And then finally, retirement means so many things to different people that it's not just a sit in the recliner and wait for people to come visit you, which is kind of the concept of retirement I had as I looked at Grandpa Bauer. It means different things to different people with varying levels of activity and maybe even part-time work or a sabbatical and going back to full-time work. It's not as easy to plan for retirement as it used to be. Now, as you move on to the question of how much do I need to save, the slide says 10%, but I would recommend that 15% is the new 10. Most professionals through at least my career have maintained that 10% was kind of a rule of thumb of how much you needed to be saving for retirement. And I still think that holds true if you want to retire in your mid-60s and have relatively the same lifestyle that you enjoyed while you're working, as long as you started in your 20s. But if you didn't start saving seriously until your 30s, you better go with 15. And if you're not getting started seriously saving until your 40s, you probably are closer to a 21% savings need of your income. But saving alone isn't enough. You have to put that money into something that has a good chance of outperforming inflation. Now, really tough to outperform inflation in the last couple of years, right? But I'm talking long-term inflation. 3-4% is the average that I'm thinking of for long-term inflation. But the most powerful thing you can do today for your retirement planning, even more than saving, even more than picking the right investments, is setting a goal. And that means set the goal of the age that you'd like to retire and the lifestyle in today's dollars that you'd like to enjoy starting at that age. Because once you have a goal, then you can start involving the people and the things that need to be involved in your life in order to accomplish that goal. How to tell if you're on track is a little more involved. It involves some calculations. We've got a worksheet that I'll introduce to you that we use to try to make it a little more easy for you to estimate if you're on track, but most professionals suggest you'll need at least 60 to 80% of the income you enjoyed while working to have roughly the same lifestyle in retirement. Why the wide gap, 60 to 80%? It all depends on tastes, but the reason why a person could live on 80% of their income and still have the same lifestyle is that you're no longer saving 10 to 15% of your income while you're retired. That's what you were saving for. And you're no longer paying 7% or so in payroll taxes that are taken out of our paycheck at retirement. Social Security makes up only about 1/3 of today's retirees' income. So where does the rest of their income come from? Of course, it comes from pensions. It comes from 401k and other savings. So let's take a look at the mechanics behind the calculators that you'll find online. If you'd like a fillable and even one with formulas in it to calculate if you're on track. You can scan this QR code and you can get this PDF, fillable PDF. So the first question that is asked is, how much do you think you'll need during retirement in today's dollars? The second question on the questionnaire is, how much do you expect per year from Social Security? Now, I've placed the average Social Security benefit on the worksheet, but if you'd like an estimate based on your earnings history, simply go to ssa.gov, register on that site, and you should be able to pull your estimated benefit statement. The new version's pretty informative because it tells you what your benefit would be if you took it at 62, 63, 64, all the way out to 70. You'll see that waiting 1 year to file for Social Security equates to an approximate increase in your lifelong benefit of about 8% per year. After age 70, as it is currently designed, there's no additional increases in your benefit if you delay Social Security past 70. So that's typically the latest age where people will file for their benefit. So you plug that in number 2
Hey,
based on the
Brian,
year.
can I interrupt you? We have one question from the chat about Social Security. It says, is only the amount over 45K or 48K of Social Security taxable in retirement, or is it all taxed?
Good question. If you make over $48,000 a year in retirement, 85% of your Social Security income is taxable. Why not 100? Because if they did, they'd almost be taxing the tax. So 85%. If your income is between 35 and 45, again, these numbers may be a couple years old, then only 50% of your Social Security income is taxable. If you have less than $35,000 a year of income, none of it is taxable. Does that help? Terrific. The third slot on the worksheet refers to pensions. That may be if somebody has a pension through their work, or you may have a rental property that you expect to be paid off by then, and that could be your pension. But whatever those other sources of income in addition to Social Security that come in, you would put those in slot number 3. Then you add 2 and 3 together to get your total retirement income from reliable sources, and subtract that from what you need, what you wrote down in number 1, and that'll give you a gap. The gap is what we're trying to solve for through your 401k savings and others. Now, to estimate what that total dollar amount gap that won't be covered by Social Security or pensions will be by the time, or maybe another way to put it is to estimate how much you would need by retirement to cover that gap is what the table on the left helps you calculate. So you take that gap in question number 5 and you multiply it by the inflation factor that coincides with the number of years you have until retirement. Let's say it's 20 years away. You would take an inflation factor of 42.3, multiply what's in box 5 by that, and that'll tell you how big of a pile of money you have to have, so to speak, by retirement to cover the gap in what you want and what Social Security and pensions would cover. On the back side, or page 2 of the worksheet, you're asked how much have you saved so far for retirement? And then again, we take table B this time, look at how many years until retirement, 20 years, and multiply what you've saved so far by 4.7, that's the growth factor from that table, and that'll tell you how much what you've currently saved will grow to if it grew at 8% per year between now and retirement. Then you compare the gap to what your current savings would grow to that we just calculated, and that will tell us if there's a gap that still needs to be addressed, that still needs to be addressed by additional savings. Now, there are calculators that can help you break that gap down into monthly savings. I just showed you an opportunity that you have to schedule a complimentary consultation to where I or one of my teammates can run those numbers for you and tell you what it would take to close up any gap if there is one. I'll show this QR code that takes you to a booking calendar at the end of our discussion today, so don't feel like you've got to get it right now. All right, so a couple more thoughts on retirement planning before we dig into investments. Number one, the maximum, because inflation has been so high the last couple of years, or at least last year, the maximums of what you can put into a 401k plan and other types of plans at employers like it has gone up. Last year, the limit was 20,500. And then if you were 50 or older, you could put an extra 6,500 in. This year, the limit is 23,500. And with the extra, I think that brings us to a total of 70,000. But let me check my cheat sheet real quick. Oh, wait. You can see my cheat sheet too, can't you? 22,500 plus 7,500. What is that up to? 30,000 as opposed to 27,000 if you're 50 or older. That's the maximum. Do you have to put that amount in order to retire okay? Well, it depends. And it depends on your calculations that we just kind of went through a minute ago. Now, most retirement plans, and if you're doing IRAs on the side of your retirement plan, you have a choice of how you want your contributions treated from a tax perspective. Do you want to put it in before tax and then pay taxes on principal and growth when you pull it out? Or do you want to pay taxes now on the principal and get both principal and growth out tax-free in retirement? There's some pretty strong opinions out there about where tax rates are going to be or have to be by the time we retire. Your tax accountant is probably the most qualified to give you advice on how to treat your contributions to a retirement plan, but let me give you a couple things to think about. First of all, to make things simple, I would say if I were a farmer, would I rather pay income taxes on the seeds and get the harvest for free, or would I rather plant the seeds and pay taxes on the harvests? That's one way to kind of simplify the thought behind it. But if I'm in the front end of my career, I'm nowhere near my peak earning years, so I'm not in my highest tax brackets of my lifetime if tax brackets stayed the same over my whole career, which is unlikely. But if I have kids at home too, I've got child tax credits that are offsetting even the taxes that I owe. So I don't have as big of a tax burden when I'm in that situation. And so it might make sense for me to pay taxes on the seeds today and then get the harvests out tax-free down the road. However, if I'm on the tail end of my career, I'm in my peak earning years, I don't have anywhere near the tax relief that I had when I was home or when I was younger and had kids at home. So my tax burden's high and I don't get a lot of relief through any tax credits or deductions. It might be better for me to do pre-tax contributions, not pay taxes on the contributions today, and get the income from it or the withdrawals on a taxable basis in the future. But again, your tax advisor is the best source because they understand all of your different deductions or credits that you would qualify for or not. So let's talk about investments. Let me pause for a minute and make sure there aren't any questions about retirement planning, any of the topics that we've covered so far. You see any coming in, Holly? I don't see any on my
I don't have any
text
coming
line
in.
either. Cool. Well, let's dig in then to investing. So let's pretend that instead of arranging this webinar, Holly arranged for the Fun Bus to come pick you up wherever you were, and we were all going to travel down to San Diego together. So imagine me standing in front of the bus window talking to you about investing to pass the time, because time flies when you're talking about retirement planning and investing, right? If we were to take on the road trip of that length, on what type of road would we spend most of our time? And Holly, if somebody texts in the answer to that, or they just, you could pass it along, or you just take yourself off mute. On what type of road would we spend most of our time on a long road trip like that?
The highway.
The highway. Why? Whoever answered highway?
Higher speed, no stop signs.
Yeah, that's right. So most of the time, freeway is going to be faster and a more direct way to get to our destination. Have you ever been on the freeway when it wasn't faster or didn't feel faster? What's that called?
Traffic jam.
Yeah, traffic jam. So when you're stuck in traffic, what does it feel like your lane is doing relative to the other lanes?
Standing still.
Yeah. And from past experience that the other lanes really aren't faster. So you try to resist changing lanes as long as you can, but your wheel finally breaks down, your WILL wheel breaks down, and you change lanes. And what happens to the fast lane as soon as you move into it?
Stops.
Yeah, it becomes the slow lane because you weren't the only one that was eyeing it. And so when your discipline breaks down and you move to that other lane, other people's discipline broke down and moved to that lane too, and now it became the slow lane. So hopefully that's if you've experienced that on the freeway, you're actually a pretty experienced investor. You know that putting some good thought into which lane you're going to stay in for the long part of the trip and staying in the lane when you hit traffic, taking a deep breath, turning on some good music, and you'll be back to freeway speeds before you know it. To give you an example of that, in March of 2020, when there were so many unanswered questions about COVID, how much intervention would there be from the government? How long would it take to get a vaccine? When there's uncertainty, the market throws a temper tantrum. And in March of 2020, the stock market dropped 30+%. And it wouldn't surprise you that when I looked back at how many shares I was buying with my constant dollar contribution from my paycheck to the 401k in February, and compared to how many shares I was able to buy for the same amount of money in March, I was able to buy 30+% more shares in March than I was in February. And the name of the game when you're preparing for retirement is accumulate as many things as you can so that you have more things to sell when you retire. So when the market is down or we suffer a 22% drop in the S&P 500 like we did last year, maybe 20%, remember how many more shares you're buying. So it's impossible to not look at your dollar amount when you log on or you look at your statement, but also be looking at the number of shares that you're buying with each contribution and the number of shares that you own. You'll notice that the number of shares you own don't go down like your dollar value does. And that the dollar value that's being quoted to you is just a reflection of what Wall Street would pay you for all of your shares that you own if you were to sell all of your shares that day. Now, even somebody retiring today isn't going to be selling all of their shares, right? They're only going to be selling 3 or 4% of the shares that they own this year to supplement Social Security and pension, and 4% or 3% of the shares that they own next year. So I hope that helps you put in perspective kind of the lizard brain, as some psychologists refer to it, that, oh my gosh, I've got to do something, as you're trying to be disciplined in the way that you react to different things happening in the market. According to Dalbar Research, the average equity fund investor underperforms the S&P 500. And that's because the average the average stock investor doesn't stay in the lane. All right, well, moving on. I want to show you kind of a visual of what I just talked about, because eventually, if you're in the express lane for the long part of the trip, eventually you're going to get to your off-ramp, right? How do we handle that? Well, 3 to 5 miles before your exit, you want to be looking for an opportunity to move from the express lane to the right lane. We know what it looks like when somebody waits too long and tries to use a shoehorn to get into that last lane and get the exit. They either cause an accident, a near accident, or they just have to wait till the next exit. Similarly, if a person stays in a stock-rich portfolio for too long, too late before they're going to need to take an exit or retire, they could end up suffering some pretty big losses at a time when it's really important, and losses hurt a lot. Prudential 3 or 4 years ago coined the phrase the retirement red zone. It's the 5 years before retirement and the first 5 years in retirement. Losses during those 10 years hurt a lot. So what do we do from an investment standpoint that is like moving from the express lane to the right lane if we were driving? This is a busy slide, but each dot on the slide represents a fictitious person in a fictitious 401k plan. And their placement on the chart is a combination of their age along the bottom and how much of their account is in stock, what percent, across the left-hand side there. So right off the bat, if I can use my laser pointer here, I see some employees that are in their 20s and 30s and don't even have 50% of their account in stock. They're going to have a hard time keeping pace with inflation, like we were talking about earlier. And then over here, I see some employees in their 60s and 70s who still have 80, 90, 100% of their account in stock. They're the ones who are trying to eke out that last bit of growth from the express lane before they jet across 3 lanes of traffic to try to hit their off-ramp. And if another 2022 happens, or another 2008 happens, or another 2001 happens, or a 1987 happens, during those 3 to 5 years before retirement and they're stuck in the express lane, they may end up having to take the next exit. Does that make sense to you guys? I hope so. So backing to a level that's less technical, in a very simple way, the investments that you have to choose from fall into one of 3 categories: stocks, bonds, or money market, or cash, or stable value, whatever they call that one where you don't lose any principal and you get a little interest rate on the savings there. You can see which ones have high risk return potential and which ones have low risk return potential. I've talked about how important it is to have a good chunk towards the top end of that spectrum during the long part of the trip. That's the express lane. A professor down at UVU who contributes regularly to the financial planning magazine that we read in the industry, or the journal, put it this way: you can't win if you're afraid to lose. Meaning, if you choose the investments that never have years with a loss, you're probably not going to be able to keep pace with inflation and have a realistic savings program for retirement. So if we were to chart those 3 investment categories between rate of return on the left and risk along the bottom, and when I say risk, I'm not talking about Las Vegas risk, where You either made a killing or you lost it all. That's Las Vegas risk. The type of risk that I'm referring to with reputable investments are measured by what we call standard deviation. If the average is here, how far do the actual results deviate from the average? If it deviates a little, that's low risk. If it deviates a lot, big roller coaster ride, then that's higher risk. So you can see where 100% stock is between return along the left and risk or volatility along the bottom. You can see how it compares to bonds and cash. But what if we were to combine some of those ingredients to create something that Stephen Covey would call synergy? 1 + 1 = 3 or more. If you were to combine a portfolio with 70% stock, 30% bond, you can see what happens, or at least happened during this 15-year period of time that I'm illustrating on the screen. It's 15 years ending in 2019. That combination would have had slightly higher rate of return and lower volatility or risk. If we took a 100% bond portfolio, which is where a generation ago, retirees would put all their money into bonds and live off the interest. If instead of that, you did a 12% stock, 78% bond again, during that period of time, 15 years ending in 2019, you would have had slightly higher rate of return and lower volatility. Wouldn't it be nice if you had somebody to help you strike those balances, those mixes, to give you a more efficient rate of return for the amount of risk that you're taking? You probably have it. Most 401k plans have something called target date funds. Target date funds actually have a year in the name of the fund. 2030, 2035, 2040, 2045. What those years are referring to is your off-ramp. So you choose a year that's as close to your retirement year as possible, and the managers of that fund will automatically de-risk, move from the express lane to the right lane so that you're well positioned to make a softer off-ramp, softer exit than you would be if you were trying to jut across from the express lane, really stock heavy, too soon, too close to your retirement. Well, again, why is it important for us to have a stock rich investment strategy while we're saving for retirement? You can see, and even why should we have any stock in our portfolio after we move into retirement? Again, we're living longer and we need more octane or growth from our portfolios to cover those the longer years that we're living. To illustrate that, if $1,000 today and 20 years from now would likely only buy $456 worth of stuff. That's if we were using a 4% inflation rate. So we've got to have money that's growing not only at the pace of inflation, but more than inflation so that we can take advantage of compound interest. So if you're in the express lane, it might look like something like this, an aggressive growth mix. 95% stock, 5% money market instruments. If you're approaching your off-ramp or you're just not as comfortable with the volatility of an aggressive mix, this one could be one where you might land 70% stock and 30% bonds and cash. As a person's getting positioned to take the off-ramp into retirement, again, that's what the de-risking process looks like. You're decreasing the exposure to stock and adding something to the portfolio that has more stability historically. There is a risk tolerance assessment or questionnaire that we make available to you. You can scan the QR code on the screen to download this PDF, but the questions largely refer to how far away from the off-ramp are you and how do you feel when the roads are slick. One question that sometimes surprises people that would be on a risk tolerance questionnaire for your retirement funds is how many months your emergency savings would cover that are outside of a retirement account. What in the world does that have to do with how much investment risk and in the investment strategy you're pursuing in your retirement accounts? Well, the bottom line is, to the extent that you've got an emergency fund you can turn to when the water heater blows up or the car needs tires before it'll pass inspection or whatever, if you've got $1,000 emergency fund to start with and you're building it to 3 to 6 months of expenses, that gives you license to take more aggressive stance in your retirement funds, because you can leave your retirement funds alone when you have an emergency. Does that make sense? I hope. So depending on your score, you might be an aggressive or a moderate or a conservative investor. Again, even during that 15-year period of time that I've been referring to that ended in 2019, think about what that includes. That certainly includes 2008 and 9. Yet it still was able to deliver an 8% rate of return from an aggressive portfolio over that period of time, one of the worst 15-year stretches perhaps that we've seen. Well, this is not a set it and forget it type of situation. Just like when you put your car on cruise control, yes, it does a lot of the work for you, but it's not something, not even if you own a Tesla, it's not something that you could just ignore and let it do the driving for you. You've got to check in on your allocations over time. Just because you chose the 2045 target date fund doesn't mean that you have the same exposure to other target date funds that are set for 2045. There could be as big of a 20% swing in allocation to stock from the most conservative 2045 fund out there to the most aggressive 2045 fund out there. So just don't take for granted that that is the right one for you. You do need to modify the allocation over time. If you're not in a target date fund, you need to make those manual shifts as time goes on. One of the best things that I think you can do for a successful investment experience is to have an accountability partner. Working with a financial professional does quite a bit to help slow things down when your brain is telling you that you need to make some big move. By engaging the slow brain, as Daniel Kahneman in Thinking Fast and Slow, his book of that title, points out, that there are some things that you run into in life where you need the fast brain, the reactive brain, the fight, flight, or freeze brain, or part of your brain, I should say. And there are other times when the consequences of the decision are far reaching and you don't have opportunities for do-over. That is the time when you need to make the decisions from the slow part of your brain to slow things down. And by having an accountability partner, somebody who's well versed in the topic that you're making a decision about, that's a pretty big deal. Vanguard suggests that it's worth 1% per year in better results in your investments. Well, we've come to the conclusion, and I'll certainly stick around for questions, but I'm placing on the screen again the QR code that you can scan to have me or one of my teammates at a local branch help run the numbers for you, and they and I'd be happy to share our observations and things that we think you might want to consider as you're planning for either retirement or you're planning for the jump. As a side note, I do have an assessment that somebody would want to fill out as they're getting close to their off ramp to see if there's anything that they've left undone. You can use the number on the screen to text me your email, and I'd be happy to share that assessment with you if that's the stage of life you're in. Holly, that's all I have. Do we have any questions that have come up as I've been yapping?
I am checking the chat. And I am not seeing any questions coming in.
Boom, that's time for me to drop the mic and walk away. No, I'm just kidding. Well, thank you for your attendance. And I was looking at the calendar. I'm pretty stoked about the topics that you guys are going to be talking about in the weeks coming up. That shows a lot of care for your future self to be engaging in educational opportunities like this. So I applaud you.
Thank you,
so
Brian.
much, Brian.
You're so welcome. Thanks a lot. Hope to run into you guys again. Bye-bye.
Yeah. Guys, don't forget to sign in for the workshop. I did throw that back in the chat, so just make sure that everyone has signed in. Other than that, we'll talk to you later.